In India, buying gold on Akshaya Tritiya is a long-standing tradition. If you look at the raw data for an investor who simply bought 10 grams of gold every Akshaya Tritiya from 2010 to 2026, the total cost comes to about 7 lakh rupees. This chart tracks the result of that exact strategy. Over those 16 years, the value of that accumulated gold climbs to roughly 26 lakh rupees. That calculates out to an annualized return, or XI, about 12%. It steadily beats inflation. But let's say you have a lump sum like 10 lakh rupees. Buying gold today with that entire amount carries a massive psychological risk. If geopolitical tensions cool and the price suddenly drops by 15% tomorrow, you instantly lose a huge chunk of your capital. On the other hand, if you let that money sit in a standard savings account, it only earns about 2 to 3% interest. You safely avoid a market crash, but your purchasing power is quietly erased by inflation.
We can solve both of these problems by using a systematic transfer plan, or STP. We will set up a system that safely generates 6 to 7% on your idle cash, while automatically buying small amounts of gold over time, so you never have to worry about buying at the peak. Here is exactly how to build it. Step 1 is getting your 10 lakh rupees out of your low-yield bank account. We are going to park it in a liquid mutual fund. This bar chart compares your current bank yield to our holding zone. Liquid mutual funds are highly secure, low-risk instruments that typically yield 6 to 7% annually. It acts as an inflation-fighting base camp for your money while it waits to be deployed. Log into your broker app, select a well-rated liquid mutual fund, enter your total lump sum of 10 lakh rupees, and execute the purchase. Once you buy in, it takes 1 to 2 working days for the transaction to settle. You need to wait until you see the liquid fund units successfully populate in your portfolio holdings before moving on. Now we have to prime your destination. Pick the gold mutual fund you want to eventually hold and make a tiny manual purchase, something like 100 or 500 rupees. This simply ensures the target fund exists in your account for the next step. You must use a gold mutual fund for this target. The systematic transfer plan feature we are about to use is currently restricted by brokers. If you try to route this into a gold ETF, the setup will fail. With your cash earning interest in the liquid fund and your target gold fund primed in your portfolio, your infrastructure is completely built. Now we configure the automation. We want to eliminate the risk of buying on the wrong day, so we will spread the 10 lakh rupee investment out over a 2-year timeline. 2 years breaks down into exactly 104 weekly segments. To find your exact transfer amount, you take your total investment capital and divide it by those 104 weeks. For our 10 lakh rupee example, the math leaves us with a precise figure, 9,615 rupees per week. By locking in a rigid mathematical schedule, you completely remove your own emotions from the equation. It no longer matters if gold spikes to 160,000 or drops to 130,000 tomorrow. You will acquire it consistently across every price point. Open your broker app and navigate to your Holdings tab. Tap the Options menu next. Enter the 9,615 rupees we just calculated. Set your transfer frequency to weekly. You can pick any day of the week you prefer. There is no hidden advantage to a Monday versus a Thursday. Next, tap the Target Destination drop-down menu. Because we primed it earlier, your chosen gold mutual fund will be waiting right there for you to select. Set the allocation rule for the transfer to 100%, ensuring the full 9,615 rupee chunk moves entirely into the gold fund. Finally, click Authorize to confirm the mandate with your broker. This flowchart tracks exactly what happens on the back end. Every week, 9,615 rupees will be seamlessly redeemed into your bank account from the liquid fund, and the very next day, it will automatically purchase units in your gold fund. No manual transferring, no logging in to check prices. Your capital is yielding interest, and your weekly gold acquisition is fully automated. Being sold off within 12 months, those weekly redemptions will incur a minor short-term capital gains tax. Your broker tracks this entirely in the background, making it extremely easy to hand off to your accountant at the end of the year. Structuring your wealth this way aligns perfectly with strategies used by top-tier hedge fund managers. Ray Dalio recommends holding 5 to 15% of your total portfolio in gold for long-term stability. If you want to get tactical, you can alter the math to create a war chest. Instead of committing the full 10 lakh to the STP weekly transfers based on just 5 lakh and let the remaining 5 lakh sit completely untouched in the liquid mutual fund,
If a global crisis hits, like a central bank suddenly liquidating its reserves, and gold corrects by 15 to 20%, you are perfectly positioned. You can instantly redeem a lump sum from your war chest. True financial resilience comes from putting your baseline wealth creation on autopilot, while keeping enough tactical liquidity to act when the rest of the market panics. Let me know in the comments which vehicle you prefer for your gold allocation: ETFs, mutual funds, or physical. Hit subscribe and click the bell icon for our next breakdown.